Hey everyone, ready for another deep dive?
Always. What are we looking at today?
Well, we're going to be tackling Wall Street Trapper's YouTube video, the one about beginner investing.
Oh, yeah, yeah,
It can
yeah.
be super overwhelming, all the different ways to get started. So,
Right.
we're going to break down Trapper's three key strategies, see which ones click for you. Sound good?
Sounds great. Lay it on me.
Okay, so first up are ETFs,
Okay.
exchange traded funds. Trapper calls it the snack aisle strategy.
Love that.
It's a good one, right? So, imagine this. You're in the grocery store. You're staring down the snack aisle.
Okay.
All those chips and pretzels and cookies. Too many choices.
Way too many.
An ETF is kind of like that aisle. But instead of snacks, it's a bunch of different stocks bundled together.
I see.
So each ETF has a specific theme, right? Like one might focus on technology stocks,
Right.
or one could track renewable energy companies, that kind of thing.
Yeah, that makes sense.
So like instead of buying one share of Apple, then a share of Microsoft, then Nvidia, you could buy one share of a tech ETF and instantly own a tiny piece of all those companies.
Yeah, you got it. That's the whole idea. It's an easy way to diversify without having to buy, dozens of stocks individually.
Yeah, that's so smart. So, for example, like if I was interested in tech, I could look into XLK,
Uh-huh.
and that might hold companies like, Apple, Microsoft, Nvidia, all those big players.
Right. That's one of the big benefits. Instant diversification. You're not putting all your eggs in one basket.
Right. Yeah.
But there's something we got to watch out for. The expense ratio.
Yeah, Trapper mentioned that. What is an expense ratio?
Basically, a small fee you pay to the fund managers who put the ETF together.
Okay.
They do all the research, picking the stocks, making sure everything runs smoothly.
So it's like a tiny commission for their expertise.
Exactly. Usually a tiny percentage.
Okay.
But it's still important to compare them before investing. Even a small difference can add up over time.
Yeah, for sure. Okay, I'm writing that down. Check the expense ratio. Now, another ETF Trapper mentioned was SDY,
Mm-hmm.
which focuses on dividends.
Right.
So does that mean the fund managers, they specifically chose companies known for paying good dividends?
Precisely. That's what's so cool about ETFs.
Yeah.
They're carefully designed to match specific investment goals.
Okay.
Whether you're looking for growth, income from dividends, exposure to a particular industry, there's probably an ETF out there for you.
Okay, yeah, I'm getting the hang of this ETF thing. It seems like a pretty accessible way to start.
Definitely is.
Yeah.
And Trapper's snack aisle analogy is so helpful.
It is. All right, let's move on to his second strategy. REITs.
Okay.
This one caught my eye because it's like investing in real estate but through the stock market.
Right. REITs
Yeah.
or real estate investment trusts.
Hmm.
They're companies that own and manage income-producing real estate.
Okay.
Think of like shopping malls, apartment buildings, office complexes, even those self-storage places.
Oh, yeah, yeah.
You see them everywhere.
So instead of buying like a whole apartment building, I could buy shares of a REIT that owns a bunch of them.
Exactly. You become a part owner of those properties.
I like
Okay,
that
that's
Trapper used Simon Property Group as an example. They own a ton of malls, right?
Yeah.
And Tanger Outlets.
Mm-hmm.
So it's like owning a tiny slice of all those shopping centers.
Exactly. And REITs are required by law
Oh, wow.
to distribute at least 90%
Wow.
of their taxable income to shareholders as dividends.
Wait, so even if the stock price of the REIT doesn't go up much, I'm still getting like a consistent stream of cash flow from those dividends.
That's the big draw.
That's pretty sweet.
Of course, the flip side is that REIT stock prices tend to be less volatile,
Yeah.
meaning they might not grow as quickly as other stocks.
So it's all about balance then.
Finding that right balance
Yeah.
for your goals and your risk tolerance.
Absolutely. Now, it's fascinating just how many different REITs there are. Trapper even mentioned Iron Mountain,
Oh, yeah.
which specializes in storing paper records for businesses, paper storage.
Who knew it was such a big business?
Yeah, I didn't know that.
There's a REIT for almost every niche in the real estate market.
Wow.
It's definitely worth exploring if you're interested in real estate, but not quite ready to buy property just yet.
Okay, so we've got ETFs and REITs, two very different approaches,
Mhm.
but both great options for beginners.
Absolutely. Each
Yeah.
with their own pros and cons.
Exactly. Now let's move on to Trapper's third strategy. He calls it the simplest way to get started,
Right.
investing in the S&P 500. It sounds almost too good to be true.
It's a powerful concept,
Mm.
and it is surprisingly straightforward.
Okay.
The S&P 500 is an index that tracks the performance of the 500 largest publicly traded companies in the U.S. So by investing in a fund that mirrors the S&P 500,
Okay.
you're essentially betting on the growth of the American economy as a whole.
Okay. So instead of trying to pick individual stocks, I'm just buying into a basket of the biggest and presumably the most successful companies in the U.S.
Exactly. And there are a couple of popular ETFs that do just that, like SPY and VOO.
Oh,
They simply hold the same stocks as the S&P 500
gotcha.
in the same proportions.
Okay. Now, Trapper shared a statistic that caught my attention. He said historically, the stock market goes up 76% of the time.
It's a compelling argument
It is.
for long-term investing.
Yeah.
Of course, past performance doesn't guarantee future returns,
Right.
but the S&P 500 does have a pretty good track record, weathering storms and bouncing back.
Yeah, it's been around for almost a century now, right?
Right.
Wars, recessions, all kinds of craziness. And it just keeps going up over the long term.
That resilience is a big part of why it's so popular with long-term investors.
Hmm.
It's not about getting rich quick.
Yeah.
It's about steady, consistent growth.
And Trapper actually said he uses the S&P 500 as his savings account. Now, that's a bold move.
It is, but it highlights the potential
It does.
for long-term growth.
It's a totally different approach to saving.
Right. It requires a certain level of risk tolerance,
Yeah, for sure.
but it aligns with the idea of investing for the long haul.
Riding those waves.
Exactly. Riding those ups and downs and letting your money grow over time.
So we've got these three core strategies then. ETFs, REITs, and the S&P 500.
Yep.
They each offer a different level of risk and potential return.
Right.
And it seems like the key is figuring out which one, or ones, I guess, best align with your personal goals.
Absolutely. Understanding your risk tolerance,
Yeah.
your investment timeline, and your financial goals is crucial.
Couldn't agree more. Now, Trapper also offered a little cheat code for finding strong individual companies.
Oh, yeah.
He suggested looking at the top holdings of ETFs, basically peeking into the portfolios of those professional fund managers
Yeah.
to see which companies they're betting on.
I like it. It's a clever way to leverage their research and expertise.
Yeah.
I mean, they have teams of analysts
Yeah.
dedicated to identifying companies with potential. So it makes sense to pay attention to what they're doing.
Yeah. So instead of me researching every single company out there,
Right.
I could start by looking at the top holdings of, say, a tech ETF.
Exactly. You're getting a curated list of companies
Right.
that have already passed a pretty rigorous screening.
Still need to do my own research, of
Oh,
course.
absolutely. Can't just blindly follow the crowd.
Right, of course not. But this cheat code,
Ah,
it seems like a good way to narrow down the field.
yeah. Focus on the companies that are more likely to succeed.
Exactly. Now, Trapper, he specifically emphasized moats when evaluating individual companies.
Oh, yeah.
He even said, and I quote, "If a company doesn't have a moat, don't invest."
Interesting.
So what is a moat in this context, I mean? Is it like the thing around a castle?
Well, it's a great analogy.
Okay.
In business, a moat refers to a company's competitive advantage, what sets them apart and allows them to stay profitable in the long run.
Okay. So it's like a unique strength that
Mhm.
makes it hard for other companies to copy them or compete with them.
Exactly. And there are different types of moats.
Okay.
It could be a strong brand,
Okay.
loyal customers,
Yeah.
unique technology, a proprietary process, even access to scarce resources. The key is to figure out what makes the company stand out and if that advantage will last.
Gotcha. So a company like Apple with its crazy loyal customers and must-have products, that's a pretty wide moat, right?
Absolutely. Their brand recognition, their design, the way they integrate their hardware and software, it's a tough moat to crack.
Yeah. Yeah. What about other companies? Like Trapper mentioned NVIDIA
Yeah.
dominating the chip market and Microsoft's operating system
Wow.
as examples of strong moats.
Exactly. NVIDIA's chips are essential for, well, everything these days,
Yeah.
from gaming to AI.
Yeah.
And then there's Microsoft Windows.
Yeah.
It's the industry standard,
Yeah.
practically indispensable for businesses.
Yeah, for sure. So those are some pretty impressive moats. Makes sense to focus on companies that have a clear advantage, right?
Absolutely.
Yeah.
Something that sets them apart.
Yeah. Now, there are different types of moats, right?
Right.
Like you said. We talked about Apple, NVIDIA, Microsoft. Trapper also mentioned Meta.
Yeah, Meta's moat is built on its massive user base and its dominance in digital advertising.
Yeah. Okay. So each company's advantage is unique.
Exactly.
Okay.
Yeah.
This is all making sense. We've
Yeah.
got ETFs, REITs, the S&P 500,
Mhm.
and now these moats.
Right.
It feels like we're building a pretty good foundation here.
And we're seeing the connections between them.
Yeah.
It's not just about picking random stocks. It's about understanding the strategies and principles that drive successful investing.
Right. We're not just throwing darts at a board anymore.
Exactly.
Now, before we wrap up this part of our deep dive,
Okay.
I want to touch on something Trapper mentioned briefly.
Okay.
Mistakes to avoid. He didn't go into too much detail, but I'm curious to get your take on some common pitfalls
Oh, yeah.
for new investors.
Definitely. Even with the best intentions, beginners can fall into some traps. It's worth exploring those.
Absolutely. So from your perspective, what's one major mistake that new investors should really try to avoid? You know, something to keep in mind as we move forward.
Well, I think one of the biggest mistakes is getting caught up in the hype, making impulsive decisions based on emotion rather than a solid strategy.
Ooh, that's a good one.
Yeah,
Like, jumping on the bandwagon when everyone's talking about a certain stock without really understanding the company or its prospects.
exactly. It's easy to get swept up in the excitement, especially with social media and all the headlines these days.
Yeah, for sure.
But successful investing requires a level-headed approach,
Yeah.
not a knee-jerk reaction,
Absolutely.
the latest trend.
So it's about resisting that urge to chase quick profits and instead focusing on building a well-diversified portfolio.
Precisely. It's about playing the long game.
Yeah.
Investing is a marathon, not a sprint.
Right.
Building wealth takes time, patience, discipline.
That makes a lot of sense. It's like instead of trying to time the market
Yeah.
or pick the next hot stock,
Right.
we should be focusing on building a solid foundation
Yeah,
that
that's
can
it.
handle the ups and downs.
Exactly. And remember, every investment comes with some level of risk.
Mhm.
It's important to be comfortable with that risk
Yeah.
and to diversify accordingly,
So not putting all our eggs in one basket.
even if that basket looks really shiny and tempting.
Exactly. Okay, so spreading our investments across different asset classes, sectors, even geographic regions, that helps mitigate risk
Yes. It protects your portfolio.
from unexpected things.
Exactly.
Okay. This is all starting to click. We've got those 3 core strategies from Wall Street Trapper,
Yeah.
ETFs, REITs, the S&P 500. We've learned about expense ratios, dividends, those all-important moats. And now we know to avoid the hype and emotional decisions.
Right.
We're on our way to becoming savvy investors.
We are. And remember, investing is a journey of continuous learning.
Yeah.
The more you explore, research, ask questions,
Right.
the more confident you'll become.
Absolutely. It's not about becoming an expert overnight. It's about taking it step by step,
It's a
building our knowledge,
Yeah.
and making choices that feel right for us.
And remember, there are resources available to help you.
Oh, yeah.
Books, podcasts, financial advisors, online communities. You don't have to go it alone.
That's a great point. So it's about finding what works for you and building your own personalized strategy.
Exactly. And remember, the most important investment you can make is in your own education.
Yeah, I like that.
The more empowered you feel, the better equipped you'll be.
Absolutely. Couldn't have said it better myself. Okay, we've covered a lot,
We have.
but there's always more to learn, right? Speaking of learning, Trapper mentioned something in his video.
Oh, yeah. What was that?
He talked about using the top holdings of ETFs as a cheat code to find strong individual companies. Like
Really?
getting a sneak peek into the minds of those professional fund managers,
Yeah.
seeing what they're betting on. I'm curious to explore that more. How do we actually find this information?
That's a great question.
Yeah.
And it's a smart strategy.
Yeah.
It's like getting a curated list of companies to investigate further. Now, there are a few ways to access this information.
Okay, lay it on me. Where do we start?
Well, many financial websites, like etfdb.com,
Okay.
provide detailed breakdowns of ETF holdings. You can search for a specific ETF,
Got it.
like SPY or XLK, and see a list of its top, say, 10 or 20 holdings,
Oh, cool.
along with their weightings within the fund.
So it's like seeing the ETF's recipe,
What?
what ingredients they're using and in what proportions.
And by analyzing those holdings,
Mhm.
you can start to identify trends and patterns.
Okay.
Companies that show up in multiple ETFs in a particular sector.
Oh, so it's not just looking at one ETF in isolation,
Right.
but seeing which companies are recurring favorites.
Exactly. It's like getting multiple expert opinions.
That's really cool.
Now, once you've identified some potential candidates,
Yeah.
it's time to do your own due diligence.
Right. Got to do